Let's talk about return calculations. Returns may seem simple. If you take 100 million and you make 200 million, you have a 100% return. But it's not that simple. There are other ways to calculate return, such as averaging it to a yearly period to compare to other instruments, or taking into account the compounding rate, that is, the rate at which you receive the dividends that you can then reinvest. Let's take a look at the three main ways to calculate returns. Return on investment is something that is crucial to investors and is actually the main factor in terms of deciding whether to keep investing in a given fund or not. However, there are multiple ways to actually calculate returns. The first is what is called the nominal return. This is the simplest form. You take the gains and you divide them by the initial investment. If you have 110 million that were made with 100 million, you have 10% returns. Very simple. The second is the annualized return. These are the returns normalized for the duration of a year. This is so allocators can compare these returns to the ones of other instruments that are yearly. So for example, if they obtain 3% returns every single month for 2 months, they are going to simulate what that would be for a whole year so that they can compare this fund to other investment opportunities, which usually present returns in a yearly manner. And finally, the compound return, which is very important. In many situations, allocators expect to obtain returns throughout the year, and they can take those returns and reinvest them, resulting in compounding returns. So this type of formula calculates the returns, including the compounding rate. Besides these, it's also normal for investors to, throughout the years, average the returns of a fund so that they can compare them on average. And there is also more than one method for the averaging. Let's take a look at some of the formulas used. The first is the nominal return. As we said, very simple. The returns divided by the original capital. If you've made $10 million extra by using 100 million, you divide them and you get 10% returns. It's that simple. The second is the annualized return. It's the total of returns divided by the fraction of the year. For example, if you've obtained 10 million in 6 months, you have 10 million here and you have 0.5 because 6 months is 0.5 of the year, 50%. And this nets you 20 million per year. It's very simple. It's adjusting the returns to the period of a year. Then we have two different examples of compounding. In this case, it's quarterly. In quarterly compounding, you divide the returns by that frequency in the year. So a quarter occurs 4 times, so you use a 4 here and a 4 here, and you put the returns here. If it's monthly compounding, you use 12, because the frequency that a month occurs in a year is 12 times. So here's a 12, and here is 12 as well. By that same token, if you wanted to use daily compounding, you would have 365 here and 365 here as well. Or if you wanted yearly compounding, it would be 1 plus the returns, because here would be a 1, and here it would be divided by 1. Compounding returns in specific are interesting because they changed based on the compounding rate itself, naturally. The extreme being that returns provided at a very long time frame, such as every few years or even longer, almost have no benefit in terms of compounding at all. And on the other hand, you have daily compounding, which generates a lot of return just because it's frequent. So compounding is usually semi-annual, which is twice a year, or quarterly, which is 4 times a year, or monthly, 12 times a year, or daily, which is 365 times a year. It's important to note that investors take the compounding rate into account when calculating returns, and in some cases, it's even possible to find other investments that may have lower returns, but they generate so much more money from compounding more frequently that they result in more bottom line returns, and they're better than higher returns with no compounding. So investors can and take this into account. What are some examples? The first is that daily compounding is enough. Naturally, the compounding rate affects returns, and the more frequent, the better. But there is a point of diminishing returns, and that is usually daily compounding. Past daily compounding, such as hourly or even more frequently, the benefits are minimum. So daily compounding is more than fine. Then, returns are averaged over a period of time, and the method itself can differ. If you have a hedge fund that has generated returns for 5 years, in some cases it's 10%, in some cases it's 3%, in some cases it might be -2%, you need to average those. And fund accountants can use arithmetic or geometric averages, and these generate different results. Another topic is that the returns can even be weighted for time, or in other words, the more recent returns have a bigger weight. Then, compounding affects returns. Literally, since compounding generates returns, investments with lesser returns but more frequent compounding can and do overtake others that have higher returns but less frequent compounding. What are our key takeaways here? The first is that there are 3 types of returns. They are usually calculated in one of 3 ways: nominal or simple, annualized, which are normalized to a yearly duration to compare to other investments, and compounding returns, which include the compounding rate into the returns. There are different compounding rates. Compounding returns can be performed with different frequencies, such as quarterly, daily, and this affects the returns at the end of the day. And finally, the compounding rate actually changes returns, and investors take that into account. So lesser returns, but with more frequent compounding, can be as competitive as better returns, but less frequent compounding. So as we see, there are multiple ways to calculate returns, and some of them actually affect the returns. For example, the compounding rate. What investors care about at the end of the day is how much money they make after compounding and after all adjustments are made.